Welcome to another episode of the Real Estate Market Minute. My mission is to help you better understand the latest trends in the U.S. real estate market and share with you my analysis and industry expertise. I want to help you gain an advantage and feel confident whenever you're buying and selling real estate. I'm your host, Mark Salib. I'm a passionate real estate professional, advisor, and investor, and I love what I do. Follow and DM me on Instagram at The Salib Group. Send me an email, mark@thesalibgroup.com. And as always, thank you for tuning in to today's show. All right, this morning, the new CPI inflation report came out much hotter than expected. And this is a huge reading on inflation as it shows that it's starting to heat back up and you got still low unemployment. So if you're the Federal Reserve, you're not going to be cutting interest rates anytime soon. And it means that the housing market may be stuck for a while in this lock-in effect that we've been talking about now for the last week or so. Let's take a look at it. So according to the data headline CPI, this is the CPI report from the Bureau of Labor Statistics. Headline CPI rose 3.8% year over year. Core CPI rose 2.8% year over year, and headline CPI 0.6% and core CPI 0.4%. Much hotter reading than expected, and it just means that inflation continues to move back up after we had a sustained period of time where inflation was making its way down. We are definitely going back up. In fact, it's the highest inflation reading in 3 years. All right, what is CPI? Consumer Price Index. So what it measures is the inflation of goods, of services, shelter, meaning the housing market, especially the rental market, more specifically. Inflation on food prices, energy prices, transportation, and healthcare costs. So it tracks how expensive everyday life is becoming. That's really the best way to look at CPI. So it's a very important reading on inflation data. And of course, we know that the Federal Reserve watches it quite closely. All right. Now, the big part of the report was about energy prices. Oil prices, as we know, have been moving quite sharply due to the Iran-U.S. conflict and the disruptions in the Strait of Hormuz. Now, when oil rises, gas goes up, obviously. Shipping costs rise as well. Transportation, airline tickets, your bill, energy bill, all that goes up, right? And all of that eventually bleeds through the entire U.S. economy. Now, how does this tie into housing? Well, if inflation remains elevated, right, the Fed has way less reason to cut interest rates because they're not going to cut rates if inflation is going up. If anything, it's the opposite. So if the markets think that inflation is reaccelerating, Treasury yields are going to go up along with it. And when Treasury yields rise, mortgage rates rise along with it. Okay, so higher inflation expectations, that's clear. Higher Treasury yields, right? Higher mortgage rates. And now we're back to affordability becoming a bigger challenge for the housing market. And therefore, you get that weaker housing activity. One of the main drivers, right? Not the only reason. We've talked about several, but that's one of the main reasons. And to show you how big a deal this really is, I want to read for you several X posts. This is from my very own feed on X. And I want to read you these reactions to show you that this CPI report was actually a little bit surprising in how it came out. All right, listen to this. This first one here from Walter Bloomberg. Inflation now outpacing paychecks. The financial squeeze is back. Inflation is wiping out all wage gains for the first time in 3 years. This from Yahoo Finance. Negative wages have set in amongst the American public. The middle class, working poor, their living standards are in decline. Yahoo Finance again, year-over-year changes in April's CPI report. Gasoline up 28.4%, energy up 17.9%, electricity up 6.1%, food 3.2%, food at home, food away from home up 3.6%, shelter up 3.3%, Uh, Yahoo Finance. Inflation's being driven by higher energy costs, Allspring global investment strategist George Bory says on the April CPI report. It just, Yahoo Finance, again, April CPI reading is the largest annual increase in 3 years. So we're not just seeing inflation rise, but we're seeing it rise pretty significantly. I don't think. Well, let me even make this even more clear. I'm 99% sure we're not getting, if not 100% sure, that we're getting any interest rate cuts this year in 2026. That to me is out the window. When you get inflation driving upwards this much, and you still have unemployment at 4.3%, remember the dual mandate of the Federal Reserve, right? Dual mandate. They got two things to worry about: inflation and the job market. Well, if you've got inflation going up and a good, strong job market, you have no reason to cut interest rates. Central banks do not aggressively cut interest rate in an environment like that. All right, so what does it mean for housing? Well, that lock-in effect that I've been talking about, millions of homeowners, again, sitting on their 2%, 3%, 4% mortgages, they're not going to give those up. So more than likely, they're going to stay put. They're not going to trade that in for 6.5%. That's where we're sitting at right now, on the 30-year fixed mortgage rate. Look, this is a concern. It's a concern because I think it's frustrating a lot of people. Buyers are looking for relief. Sellers want higher prices. The market wants lower rates. It really needs it. But you just can't get it in this environment. You can't keep causing inflationary situations, let's call it, and expect that you're going to get lower interest rates. It doesn't work that way. Never has. So, the housing market may stay frozen. It may stay stagnant. It may stay unaffordable. But prices, they're holding on. But again, it's a transaction recession, and it will continue to be. All right. Now, here's my concern. That this is a higher for longer situation when it comes to interest rates, right? Because you're actually getting pretty decent wage growth. And I think that if you're a buyer of this market, waiting for lower mortgage rates is just not going to happen, right? And I hope that there are buyers that come to terms with that, because that could actually improve, that slow sort of transactionary period that we're in. But that ultra low rate that we got during the pandemic, it's just not coming back anytime soon. It's definitely not coming back this year. It would take a real serious event that would cause a recession or worse, to get back to a situation. Remember, it took a global pandemic to cause interest rates to go that low. That was a response to that. So unless you think that's happening again, it's just not, you can expect rates to kind of stay pretty much where they're at. Well, look, I talk about this more in some of the bonus episodes, so I definitely, suggest you check that out. But I think that for now, inflation keeps moving higher. It's in the data. Unemployment is low. In general, Americans are still spending money. So that environment, you're not getting lower rates. That path toward lower mortgage rates is going to take a lot longer than many people think. And unfortunately for the housing market, it may just keep it stuck in this place that we've been in for a while for the remainder of 2026. That is it for me today. Thank you so much for listening to today's show. And as always, If you have questions or need specific advice, ideas, or just some help regarding your particular real estate needs or situation, or if you're just looking to buy or sell real estate in Florida, well then DM me on Instagram at The Salib Group, or just send me an email to mark@thesalibgroup.com. Don't forget to leave a rating for the show, follow, subscribe, help others find the show, and be informed and educated about the real estate market just like you. Until next time. Before we end today's show, stop what you're doing and subscribe right now to Real Estate Market Minute Plus. Listen to all episodes ad-free, get exclusive bonus episodes and content, and help support the show's growth, longevity, and future improvements. Go to realestatemarketminute.supercast.com right now. You can also find the link in this episode's show description. Check it out. I know you'll love it.